The Nobel Prize is the highest award in human history. But does that mean it must be the truth? Today we are bold enough to find loopholes in the Nobel Prize. On October 14, 2013, the Royal Swedish Academy of Sciences announced that Eugene Fama, an expert on the efficient market hypothesis, and Robert Shiller, a professor of behavioral finance, were awarded the Nobel Prize in Economics that year in recognition of their new methods for studying the development trends of asset markets. The Royal Swedish Academy of Sciences noted that 3 economists laid the foundation for the perception of asset values. There are few ways to accurately predict the direction of the stock and bond markets over the next few days or weeks, but it is possible to make predictions about prices over 3 years through research. What is the efficient market hypothesis? The efficient market hypothesis has the premise assumption that investors participating in a market are sufficiently rational and able to react quickly and reasonably to all market information. The theory holds that in a stock market that is legally sound, functional, transparent, and competitive, all valuable information has been timely, accurately, and adequately reflected in stock price movements, including the current and future value of the enterprise, and that, unless there is market manipulation, it is impossible for investors to analyze past prices to obtain excess profits above the market average. Loophole 1. Investors are rational enough. This is the most obvious loophole in the efficient market hypothesis. After nearly 10 years of working in the investment market, I have seen a large number of investors, at least domestic investors, and I can say that more than 90% of them are not rational at all. Whether it is stocks, foreign exchange, futures, if the investor is rational, then there will not be a come up to the full position dry situation, but such investors are too many. Often see some novice foreign exchange full position to do a single burst position, stock full position high set, and so on. If the investor is rational, that is not in a very short period of time to lose all, but the fact is not so. In foreign exchange, for example, the newbie from the gold trading began to burst the position almost no more than 3 months, or even no more than 1 month, which is the current Chinese foreign exchange of the true portrayal. If investors are rational, then at least the vast majority of investors will set stop loss. But the reality is just the opposite. Many newbies almost no stop loss, and finally died in the big single edge. According to Robert Shiller, author of Irrational Exuberance and professor of economics at Yale University, markets can sometimes be swayed by lunacy and collective hysteria. This is true. Toward the end of a bull market, investors smash their pots and pans and pour in like crazy, not even looking at what stocks they are buying, which is what investors do in real environments. So, the market efficient hypothesis assumes that investors are sufficiently rational, and this one is actually quite implausible, because the population of the financial investment market is very irrational. Loophole 2. Rapid and simultaneous response to market information. This loophole is also a perfect assumption. First of all, investors cannot receive the market information at the same time. Even if the most transparent information foreign exchange market, a lot of data have been able to know the time in advance, but there are still a lot of sudden events, and even a lot of data in advance to be leaked digested, the so-called by the expected to sell the fact. The market wants to run steadily down. Investors will always have a hierarchy, like Kim Jong-un around the people. If you want to do more gold, certainly more than the average investor has a greater advantage. When they determine a few hours after the launch of missiles, their hierarchy is in the highest financial market. By an advance of the long single is to rely on the priority of information to obtain the benefits. Ordinary investors can never imitate. This kind of thing happens all the time in Europe and the United States. It's just that it's better disguised to give the illusion of openness and transparency. Even if we get the same information, 1,000 people have 1,000 hearts Hamlet, who can guarantee that investors think and react the same way. The same news in the bull market and bear market will have a different reaction. even if it is the price-earnings ratio, the market-net ratio of familiar data. Everyone still has their own views, just sometimes everyone's view of the centralized. And sometimes there is a view of the divergence only. If all investors at the same time to make the same reaction, the market price will instantly rise or fall to the limit. In the foreign exchange market is an instant rise or fall of hundreds of points or even thousands of points, such as the pound out of the European Union one day plummeted 1,800 points in the stock market is an instant seal stop or stop, because we all have the same view. There is no reverse sell orders, so the transaction price is directly the price of the stop. But this is a small probability event. 99% of the time the price is a moderate trend, which can be launched. The vast majority of the time the market investors cannot make the same reaction at the same time. Loophole 3. Can't predict the future from past prices. The Royal Swedish Academy of Sciences points out that there are few ways to accurately predict the direction of the stock and bond markets in the coming days or weeks. But the market is actually the opposite of what these scientists think. Not only can past prices predict the future, but they can also be very accurate. However, for the vast majority of investors, it is true that it can be said that it cannot be predicted, but this does not mean that the market is completely unpredictable. If the market cannot be predicted at all, then the financial trading market investors are gamblers, or even worse than gamblers, because there are brokerage firms and other additional costs. This is a negative-sum game. No one can make money. But the reality is not quite like this. Many professionals with their own performance prove that the market is predictable to a certain extent. Futures Ledge internal trading method mentor Richard Dennis, for $100 into $200 million. Foreign exchange bank trader Bruce Kovenag, 1978 to 1987, the average rate of return of up to 87%, which means that you give Kovenag at the beginning of 1978's fund at the beginning of 1978, and 10 years later your money would turn into $5 million. Michael Marks grew 2,500 times in 10 years, growing the $30,000 the company gave him to $80 million. And that's not counting Warren Buffett, Soros, James Simmons in the U.S., Kawajinzo in Japan, BNF. Loophole 4. Can't outperform the index, just follow it. It's true that the vast majority of investors can't outperform the index, but that shouldn't be a reason to become mediocre. There have been many bulls above who have proven that the market can be surpassed. If the index cannot be exceeded, then there is still a need for so many fund managers, traders, analysts what to do, all go to buy an index fund can be, that the market will become how monotonous. If no one to buy stocks, the stock market cannot serve the entity. If you only need to follow the index to make money, that also have to catch up with the good times, exactly the same as the risk of buying an individual stock. If you buy a Japanese index fund in 1990, then you hold 18 years from 38,957 points down to 6,994 points, or floating loss of 82%, that is, you invested $1 million. Do a long term of 18 years is only $180,000. Take now the past 27 years, but also 40% floating loss. The sky will not fall off the pie. The fool to buy the opportunity to make a lot of money, but there are prerequisites. The premise is that you catch up with the bull market. If you catch up with the bear market, it will enter the long road to be set. Summarize. Practice is the only standard for testing the truth, no matter what theory. Even if it is a Nobel Prize theory, if it cannot be applied to the market, it should be treated with caution. Let us keep independent thinking as close as possible to the truth of the market.